Welcome to the Infinite Banking Versus series, where we compare popular financial vehicles to help you make smarter money moves. And today we're putting infinite banking, the infinite banking concept, head to head with one of the most widely used wealth building tools, which is just the stock market. It's a battle of stability versus potential, and there's a lot to unpack.
There definitely is, Jonah. So today we're going to explore this comparison through the lens of our 8 ideals, as we like to call them. That's guarantees, constant compounding, liquidity, flexibility, privacy, taxes, rate of return, and passive income stream. By the end of this video, you'll see the strengths and the weaknesses of each approach, so you can decide what's the best fit for achieving your financial goals. And hey, if this sounds like the kind of content you've been looking for, be sure to hit that like button and subscribe so you can check out our full IBC Versus series. Now, let's dive into it.
For those of you who aren't familiar with these two vehicles, let's start by explaining them. The stock market is the cornerstone of most investment portfolios. It has options like stocks, ETFs, mutual funds, and it's known for delivering high returns over the long term. In fact, the S&P 500 has averaged around 10% annual returns historically. But it's also versatile. In any given year, you could see double-digit gains or losses. It just depends on market conditions.
Infinite banking, on the other hand, is built on a specially designed whole life insurance policy chassis. So, unlike the stock market, it prioritizes guarantees, steady growth, and control. Instead of chasing market returns, you're building a financial system that works for you, reliably and predictably, regardless of external economic conditions.
Awesome, Shawn. So what do you say if we hop right into comparing these two things using our 8 ideals? So first up of our 8 is going to be guarantees. We want to know, does the stock market offer guarantees? Does infinite banking offer? Which one has this? So the stock market's up first. The stock market offers absolutely no guarantees. While historical data shows the average returns somewhere between 7 and 10% annually, these returns are not consistent. And that also is an average return. So here's the problem with that. If the first year you put your money into the market, you have a negative return, and then the next year you've got a positive return, so your average is 10%. The problem is that your balance, your starting balance went down. So even if you earn a big return on a now lesser balance, you might not come out with more money, even though you've got an average that's positive. So here's an example. During the financial crisis of 2008, the S&P 500 dropped by nearly 37%. So even with recovery, these swings make it very difficult to plan confidently. All in all, when it comes to guarantees, the only guarantee that you have here is that you just can't lose more than everything. Like you can't go below zero.
I find comfort in the fact that the most I can lose is everything. So thanks, Jonah. Well, when it comes to infinite banking policies, they actually offer contractual guarantees. Your cash value grows every year at a guaranteed rate, no matter what happens in the stock market or the economy. You also have a guaranteed tax-free death benefit, which I would say is a lovely bonus amongst many other things that we're going to touch on as we go through this. But these policies are really designed for more stability, making them a great choice for anyone who values predictability and guarantees in their financial plan.
I really like the sound of that, Shawn. Next up though, we've got constant compounding. Now, compounding in the stock market can be an incredibly powerful over time, but it's just not consistent. Market losses interrupt growth, and if you withdraw during a downturn, it's literally like a double hit. We refer to that as sequence of returns risk. Recovery can end up taking you years depending on the severity of that downturn. So yes, it does have the potential for some massive constant compounding. It's just not uninterrupted constant compounding like I think you're probably about to mention, Shawn.
You're right, Jonah. One of the things I like best about IBC is when it comes to the compounding, there are no interruptions. I'm talking about even if you borrow against your cash value, the policy continues to grow as if you never touched it in the first place. This uninterrupted compounding is really one of the most powerful aspects of infinite banking, and I believe it's something that not only the stock market, but very few other vehicles out there in the market can even offer.
That does sound like a really important feature. So I don't know about you, Shawn, but I'm of the opinion that I should have access to my money, like, because it's mine. So let's talk about liquidity. Liquidity in the stock market really depends on the type of account. For taxable accounts, you can sell the investment anytime, but then you'll pay taxes on the gains. In retirement accounts, which are tied to the stock market, like 401ks and IRAs, withdrawals before you becoming of age, most of the time that's 59 and a half, often comes with penalties and taxes. So limiting a lot of the access to your money. So because the stock market covers so many different areas, I will say that yes, you can definitely have access to some liquidity. It's just going to depend on what type of vehicle you invested through.
Yeah, it's definitely important to know exactly where your money is at and understand the rules of that vehicle. So when we're talking about infinite banking, we're talking about almost unmatched liquidity, meaning you can borrow against your cash value anytime for any reason without penalties or taxes or any stupid invasive questions about why you want your money and what you plan to use it for. We know those questions. Like, isn't it my money in the first place? I think this kind of financial flexibility is really invaluable in emergencies or when just like a nice juicy opportunity arises that you want to take advantage of.
I do enjoy a good opportunity to put my money to work. Shawn, I think that's the perfect transition to talk about our next ideal, and that is flexibility or use. So stock market investments tend to be flexible in terms of a diversification and use, but liquidating those assets can absolutely disrupt your overall strategy. You can liquidate at the wrong time. It becomes such an important factor here. So here's what I mean. If you sell during a downturn, you actually lock in the losses that could then take you years to recover. Imagine if you needed to retire during 2008, or you wanted to sell during 2008 when the market dropped 37%. If you drop 37, then you sell, you've locked it in, right? Like that's your loss. You're never going to recover from it.
Yeah, I don't know about you, Jonah, but I have yet to figure out a consistent way to time the market. But if at some point you never hear from me again, realize I probably cracked the code to timing the market and I'm just out relaxing on a beach somewhere. But I don't see that happening. So let's talk about how infinite banking policies are designed for ultimate flexibility, whether it's funding a business, paying for college, or making a real estate investment. You can use your cash value for whatever you want without interrupting its compounding growth. Plus, you set your own repayment terms for the loans, so you're in complete control. Now that is flexibility.
Okay. I do like the sound of that, but what about privacy, Shawn? I know as people start to make more money, they want to make sure it's protected and private. And I'm going to be honest, stock market investments don't really shine here, like at all. These things are super heavily regulated. Every transaction is tracked, and you're subject to oversight by the brokers, by the financial advisors, the government agencies. Basically, what I'm saying here is there's little room, if any at all, for any real financial privacy.
Well, Jonah, I think you'll enjoy this then. Infinite banking policies offer unparalleled privacy. Were you aware that policy loans don't require credit checks or any sort of invasive financial documentation? And your transactions stay between you and the insurance company, meaning when I take a loan, it's not going to show up anywhere on any of my records. Plus, I didn't even mention the fact that in most states, your personal banking policy is going to be protected against liens and lawsuits, meaning nobody's touching your money.
Like you said, I love my privacy. But let me ask you this. How in the world does the infinite banking concept fare when it comes to taxes? Because the stock market can be a huge tax efficient tool if you use strategies like tax loss harvesting or hold investments long term so you get the lower capital. But of course the gains are still taxable, and tax laws have been known to change over time. So Uncle Sam's still definitely getting his, but talk to me about infinite banking.
Yeah, man. I mean, ideally, we'd like to pay as little taxes as possible. At least, that's what I would want. So I prefer to handle my tax stuff now and allow myself to get taxed on the seed, not that harvest, that big portion in the future. You see, infinite banking policies grow tax deferred like a lot of other accounts out there, but policy loans are tax free, and we can actually teach you how to get the absolute most out of your policy without ever having to pay any additional taxes. On top of that, like I mentioned before, the death benefit is paid out tax free to your beneficiaries. To be honest, I think IBC creates an incredibly tax advantage financial system that complements a lot of other investments out there.
It does seem like a great thing to pair with a lot of other vehicles out there. So, okay, we've only got 2 ideals left, and I think this is the one where stocks shine the most, and this is rate of return. So we all know that the stock market's potential for high returns is undeniable, and I am talking 10, 15, 20, 30%. But I'd be lying if it didn't come with significant risks. I think the stock market has a ton of benefits, but people just don't fully understand what level or allocation of their money they realistically should be putting at risk versus the amount they should have tied to something with guarantees.
Yeah, Jonah, I think understanding that is crucial to your financial future. There's a recent article out there by Ernst & Young that actually discusses that. In that article, they're actually only talking about generic whole life not being used for infinite banking, but they do prove that a nice blend of whole life in your portfolio is the best overall option for retirement success and constant cash flow. We'll go ahead and link that article in the description section below so you guys can check it out. But when it comes to infinite banking, most people know that the focus isn't on rate of return. The focus is on steady, predictable growth. That means you won't be seeing double-digit returns unless we get a few years in and you're looking at the cash-on-cash returns. But at the end of the day, what you do with the money in your system is what's most important. And that's really where we end up getting that strong rate of return at. But if we're just talking about the policy itself, the combination of guaranteed growth and dividends can provide long-term performance that's often more reliable than the market.
All right, Shawn, so as we wrap this up here, the last ideal that I want to touch on is extremely important for people, especially entering the later years of their life, and that's passive income or cash flow. We need a stream of money here. Now, the stock market can create passive income through dividends or withdrawals in retirement. However, relying on the withdrawals during the market downturn can deplete your portfolio way faster than expected. Remember, that's the sequence of returns risk I referred to before. When you access the money is actually extremely important when dealing with the stock market. I think a lot of people miss that. They try to invest their money in the stock market through all their working years, maybe 20 or 30 years old, all the way to 50 or 60 or 70 years old, and they think they did it, and they don't realize that if you need to go withdraw that money for the next 20 years, you still need to avoid the downturns in the market. Because if you lose 10% one year and you take out a bunch of money, you're really going to be hurting.
Yeah, Jonah, passive income and cash flow is everything when you start to approach those retirement years. With infinite banking, your cash value can be leveraged to create passive income without actually interrupting the growth of it, which means you can send that money out to make you more money while your money is still in the policy making you money. I hope you followed that. It's a pretty crazy concept. I also want to mention that in retirement, you can structure loans or withdrawals strategically, ensuring that you have a consistent income stream that's actually not tied to the market performance, meaning that you know what you're going to get.
Great stuff, Shawn. To wrap this all up, the stock market offers high growth potential, but it does come with significant risks. It comes with volatility, and it comes with a bunch of dependency on just external things you don't control. It's a great tool, but it's not without its challenges.
Agreed. And infinite banking, while not as flashy, offers stability, control, and flexibility that can complement or even replace market-based strategies, depending on your goals. It's about creating a system where you're in complete control.
Ultimately, the choice depends on what's most important to you. Do you value the potential for massive gains in the market, or do you prioritize guarantees, control, compounding growth?
So if infinite banking sounds like the right choice for you, or if you're curious about how it could possibly transform your financial strategy, click the link in the description to schedule your free cash consultation call. Let's hop on, discuss your goals, and find the best solution for your financial needs.
Thanks for watching. Don't forget to like, subscribe, and hit the notification bell so you never miss another video we put out. And if you found this video valuable, please share it with a friend. If you've got questions, we'd actually love to hear your thoughts. Just put them in the comments below. I promise you we'll actually answer them. And remember to go check out our other videos in this IBC Versus series by clicking the playlist. And anyway, we'll catch you next time.